visible to everyone?
Yes.
Okay, thank you, Vishal. So, Vishal, you can
Yeah.
put mute, right? If you have any queries, you unmute yourself and you ask me. Okay. So I am muting you from
Okay.
when
Yeah.
you want, you can unmute yourself. Thank you.
Okay.
Okay. So, so I have Vishal and Karan joining us new today. So what I'll do is I'll quickly recap the parts that we are talking about that we were discussing in the last session, and from there we will start off our discussions further. So last week we just had one session, right? So Vishal, you did not miss out much. So basically, we just had a a overall understanding of Basel models. We started talking about Basel with as we initiated our journey into credit risk modeling. So I'll just do a very quick recap of the stuffs that we have done, the components that we have been talking about, and from there we will take up today's discussions, right? So as you know that, as we know that banks are financial institutions who are into lending, right? So basically, what a bank does essentially is, so the bank lends from a low risk segment and lends to a high risk segment, right? So when I say a low risk segment, what is a low risk segment? The low risk segment is nothing but the the low risk segment is nothing but is the depositors, right? So we go and deposit money to the banks. The bank uses our deposit and lends it to high risk, relatively high risk segments, say to entrepreneurs, to retail, to household for retail purposes, and so on. And when they lend out the money, right, there is always a risk associated with them on the fact that they may or may not get back the money, right? So so this is the risk that they bear, the risk of credit default, right? And this risk of not getting back the money is what we call the credit risk. Okay. So as I was saying, that banks lend from the low risk segment, and they they borrow from the low risk segment and they lend to the high risk segment. So what is the low risk segment that we are talking about over here? The low risk segment that we are talking about over here are the depositors, right? The depositors are the one like you and me who go and put money into the bank, and the bank takes that money, lends it out to other risky ventures, and hence from there what they do is they you know they lend to the high risk segments like entrepreneurs, to retail house, to households for retail loans like personal loans, to automobile loans, mortgages, etc. Now when banks do these lending, they always bear a risk, right? So what is the risk that these people, or what is the risk that the bank bears? The risk that the bank bears was, or the risk that the bank bears is the risk of default. So what is this default? The default is that I might take the money and say I take a personal loan from the bank, but I do not return back the entire amount of money. So that is called the credit default, or as we call it, the credit risk. Now, when we talk about the credit risk, so any bank can face this risk. So let us start with this example that there are, say, around 100 depositors who have deposited 100 rupees with the bank, right? So the total deposit that the bank has is rupees 10,000, is rupees 10,000. Now, there is a businessman or an entrepreneur who comes to the bank asking for the rupees 10,000 or a loan of rupees 10,000. So the bank gives the entrepreneur the loan of 10,000. Now the question that comes out over here is that what exactly is the profit of the bank? So when the bank takes the deposit, or when the bank borrows the deposit money from the depositors, the bank pays a rate of interest, say 4%. Now, when the bank lends to the entrepreneur, the bank lends it at, say, 12%. Now, assuming that the entrepreneur pays back the bank the entire money, the profit of the bank will be the interest differential of 8%. It is this interest income that the bank actually incurs. And in the case of no default, and in the case that the borrower does not default, right? In the case that the borrower does not default, the bank is going to earn a profit of 8%. The depositors are going to gain a interest of 4%, and the entrepreneur would be able to set up his business. So in the case of no default, it is always a win-win game for all the agents involved in the for all the agents involved. Now the next question that comes over here is that what if there is a default? So the question that we are going to answer over here throughout the credit risk modeling module is the what if analysis. What if? And how is it that you can prevent this what if to occur, right? So now when I am now thinking about myself as a bank, my objective would always be to keep myself insulated against such losses, because when the bank does this exercise, or if a bank is lending as per this strategy, right? When a bank is lending as per this strategy, what happens is the following. The bank is lending out the entire amount of fund, and hence it is not keeping back any reserves. So it does not have any reserves. Now, given that the bank does not have any reserve, it is exposed to a whole set of risks. So there are no reserves. And given that there are no reserves, the bank is exposed to a whole set of risks. So what are the risks? Let's take that the entrepreneur to whom the bank had lent out, this entrepreneur, he defaulted. So the question that comes out over here is, what is default? By default, I mean that the borrower who had taken the money has not been able to pay back the money. So he was supposed to pay back to the bank a sum which was equal to the principal plus interest, right? Now, over here, when we talk about this default, it means that the guy did not pay back the entire amount of principal plus interest to the bank. So that means the bank had lost out some of the amounts. Now, a default can be a complete default. So let's assume for simplicity that this entrepreneur did not pay back anything to the bank. So the amount of loss that the bank had was full 1,000 rupees or 10,000 rupees. So the loss arising from the credit default to the bank was 10,000 rupees minus 10,000. So the bank had lost 10,000 bucks. Now the question is that what are the other risks to which the bank is exposed to? So the bank is exposed to a whole set of risks apart from these two basic risks. What are they? Now over here, the first thing that has happened to the bank was a credit risk. So the borrower defaulted, and that is what was the credit risk. And in our discussions throughout, we would be mostly focusing on this risk broadly. Now, the next set of things that we have over here is now, now imagine that the next day the depositors would come back, right, to draw their money, but the bank had not kept back anything and it had lent out the entire amount. Therefore, the next day when these guys come in, the bank enters into a liquidation risk. The bank would be in a state of liquidation because they do not have any additional funds to pay back the depositors their money. So this is the liquidation risk. So from the credit risk stems out the liquidation risk. Now, when the people they do not get their money, right? So they start losing confidence on the bank and they start closing off their accounts. Therefore, the next set of risk that the bank faces over here is that of the reputation risk, right? So, what exactly has been the flaw in the banking strategy which is exposing it to all these risks? So, what has exposed them to all this risk is their lack of ability to keep back the sufficient amount of funds before they have lent out. So basically, what I can say is that the bank had not made sufficient business or risk management strategies in place. They had not put enough risk management strategies in place, which would actually help them, you know, which would actually help them manage these kind of default risks. So while we talk about credit risk modeling, we would essentially be talking about these risk management strategies. So what are the ways through which the bank can manage the risks associated with credit lending? So this is where risk management strategy comes in. Now, on one side, while I talk about the risk management strategy, Through this, the bank can mitigate the risk, right? And one of the ways of risk management strategy, or rather, just I would say that one part or one pillar of risk management strategies is to build risk models. Models which would replicate the portfolio behavior of the credit risk, right? So, which would replicate the risk behavior of the bank, right? Now, while I talk about risk management strategies, there are two broad pillars, or there are two broad types of risk management strategies, or two broad areas to discuss on the risk management strategies. One such area, or one of the broad area, is the business strategies, right? So when I talk about the business strategies, so within the business strategy, we talk about developing application scorecards to manage origination risk. We talk about behavior scorecards to manage behavior risk, and so on, right? Now, the second part is the capital management. The second part that we have over here is the capital management. Now, what is capital management? The capital management is there to ensure that the bank is capital adequate, or it's adequately capitalized, such that in cases of defaults, right, even if there are defaults and even if there are borrowers who do not pay back the money, the bank would have sufficient amount of funds, a sufficient amount of money set aside, which could absorb those losses, right? So that is where the role of capital management comes in. Now, the question that you might, that you might ask is that if we have the business risk management strategies, why would I need a capital management separately to be done? So, because I'm already managing the risks. So, let's try to understand why we need both these two in place. So, the first reason as to why I would need to in this place. So, let's, guys, am I audible? Can everyone hear me? Okay, great.
Yeah, Tanmay.
Okay, thank you. So the question that comes out over here is that why would I need a business capital management strategy, even though I have a business management strategy? So let's take a look into this. So let's take this example, right? So it is this entrepreneur who comes up and asks for a loan of 10,000, 10K. Now, the first question that the bank would answer over here is that should I give him the loan? Give the credit, yes or no? So that's the first question that the bank asks. Yes or no? So now the question, so this is a part where the bank is deploying its risk management strategy. Now suppose the bank gives him the loan. Say it's a yes. So he gets the loan. Now, when he gets the loan, so he gets the loan because the bank believes that he is a good borrower. Now, when he is given this loan and the bank believes that he is a good borrower, the question that arises over here is, on what grounds does the bank believe that this is a good borrower? So what the bank has assessed for him was, say, his affordability for the product and his reliability as a borrower, right? So, talking about affordability and reliability, we'll just clarify these terms. Say, for example, Mr. Mukesh Ambani is an affordable borrower for a credit as well as he is a reliable borrower because he is a well-known business person and he resides in a well-recognized area in India and he is an Indian citizen and he has all the demographic requirements of reliability, right? He has a good and stable job, he has his own small company, and the bank will very happily give a credit away to him because they know that this person would be in a position to pay back his debts. Now, the next borrower that the bank considers is, say, suppose it's Mr. Osama bin Laden, right? Now, Mr. Osama bin Laden, by all means, is an affordable borrower for a credit, but it's just that he's not a reliable guy. Why not? Because of his because of his reputation, that he is a quote unquote terrorist and he used to reside in one of the caves in Taliban, right? And he could use this credit for creating some explosives which can blow off another World Trade Center. So therefore, if these two borrowers go up to the bank to take a credit, the bank would always prefer to give Mr. Ambani the credit than Mr. Osama bin Laden, even if both of them can afford to get that credit, right? So therefore, this is the assessment which the bank does. Now Mr. Ambani is given the credit. So what is so at origination, while acquiring the borrower, the bank has deployed its business strategy, its acquisition business strategy, right? So the risk management strategy. So two broad strategies which a bank would follow. One is an origination strategy. So now the bank selects its borrower and it gives Mr. Ambani the loan, and that is what its origination strategy is. That if I see that if there is some person who has a ill reputation or is not a reliable borrower, will not be giving him the credit. We would be giving the credit to borrowers who are reliable as well as who have the basic affordability to get that particular product that he's applying for. Now the bank gives the credit. So what is the next thing that the bank needs to do? The bank needs to monitor, right? The bank needs to monitor the payments that Mr. Ambani is making. Now, when the bank is monitoring that, this is the behavior risk management strategy because he is actually monitoring how is Mr. Ambani paying back his dues. So if Mr. Ambani has taken a personal loan, which is not a secured loan, so this is not secured by any collaterals. So the bank is actually monitoring whether this guy should be or how likely is this guy that he should be given the credit, right? Now from there, so he monitors Mr. Ambani's monthly payments, right? Now if Mr. Ambani misses out on paying uh, the credit for a month, after a few days they start giving him a call, reminding him of the credit and so on, until and unless he pays it. And if Mr. Ambani does not pay the credit that month, Mr. Ambani is flagged as a delinquent borrower, right? So in the monitoring exercise, the objective is to assess whether a particular borrower is a delinquent borrower or not. Delinquent or non-delinquent borrower. right? Now, the bank sees that with the amount of money that Mr. Ambani has and with the type of the way he operates, he is never a delinquent. So he is always a non-delinquent borrower, and hence the bank realizes that Mr. Ambani has a good willingness to pay back the dues that he has taken, right? So if in the monitoring stage, right, which is also known as the account management stage, right, through proper account management strategies, you know, the bank can uh, the bank can actually try and identify the willingness of the borrower to pay back, right? So this is the second type of risk management strategy that a bank takes, which is the behavior risk, which is the behavior risk or the behavior risk management strategies. Now, when I talk about the behavior risk management strategies, what we are trying to understand over here is the following. Right? So, what we are trying to understand is that how good or how bad is this borrower? So, what is his willingness to pay back the credit? And I see that Mr. Amani is a perfectly diligent borrower who is paying back his credit every month. But still, I keep on monitoring his account on a month on month basis, right? So I know that he is a good borrower. But what I next enter into is the capital management strategies. So what exactly is capital management strategy? So the question that comes out is, why would I need, if Mr. Ambani is on my books, why would I need a capital management strategy, and what should I do in a capital management strategy or in capital management exercise? How do I manage risk with capital management? So what I'll do over here is I'll keep on monitoring this, and against Mr. Ambani's name, I'll keep aside some amount of funds. Even though I know that Mr. Ambani is a very good borrower and he is not defaulting, but why would I then set aside a money against his name? I would set aside a money against his name because I know that one fine morning Mr. Ambani's business can go face a downswing, and then his ability to pay back my credit may deteriorate. And hence, what I would do is I would always keep aside a money against Mr. Ambani's name. So the next question that comes out over here is that how much money should I set aside, right? So how much money should I set aside? Obviously, I should try to assess the riskiness that is associated with Mr. Ambani and then accordingly set aside the money, right? So the question that comes out over the next question that I need to answer is that how do I assess the riskiness of Mr. Ambani? That's the first question. Why can't I set aside an arbitrarily high amount of money against Mr. Ambani's name, even though he is going very good? So the answer to the first question is that I need to understand first of all, I need to assess the probability that Mr. Ambani may default in the long run. So in the next 12 months or in the next 6 months or in the next 18 months, what are the chances of Mr. Ambani to default? So that's the first thing I need to know. I want to understand how risky Mr. Ambani is as a borrower. The second question that comes out to me over here is that how is or like why should or how much of amount should why should I not set aside an arbitrarily high amount against Mr. Ambani's name? Because that will be conservative. The reason is this money that I'm setting aside has an opportunity cost. Now, if I'm setting aside this money against Mr. Ambani's name, I I am blocking this money out. And this money that I'm setting aside, right, comes from my profits that my bank has earned. So if I do not set this money aside against Mr. Ambani's name, or if I set aside a lower amount of money against Mr. Ambani's name, then I would be able to use those funds to pay profits to my shareholders, reinvest to expand businesses, and so on. Right? So that is the reason where this concept of provisioning comes in. Right? So capital needs to be optimally managed, right, such that the bank is insured against all type of losses, and at the same time the bank can also pursue some expansion opportunities as well. So you need to optimize, you need to manage capital very optimally, and that is the part where capital management, or the role of capital management, comes in, right? And the guidelines, which is laid out for this capital management, right, those are the very famous Basel Accords that we get to know, right? So capital management business strategy. So capital management is something which we which is guided by the regulator. So how much of capital that a bank should set aside, on what are the parameters based on which we would decide the optimal amount of capital. So this is where the role of capital management comes in, right? And when we talk about capital management, you know, capital management is involved, or capital management tries to, or must be done such that the following losses are taken care of. So first is an expected loss. So the amount of loss that the business expects. The second is the unexpected loss, which is the variation about the expected loss. Right? And the third that I have is the potential loss. So these are losses which may occur, but have very rare chances of occurring. But if they do occur, they may take the bank to crash. So they may cause the bank actually crash. These are the three types of losses that we generally tend to cover, or a capital of a bank needs to cover up, right? And so basically, what are these kind of losses? What is expected loss? What is unexpected loss? And what is potential loss? And why are we defining the losses in these three ways? Let's say, for example, let's take a very simple example. Let's bring in Mr. Ambani once again. Now, Mr. Ambani is on the books of the bank, right? Now he is performing. The bank authorities see that Mr. Ambani has a credit card with the bank, Mr. Ambani has a personal loan with the bank, and Mr. Ambani has a mortgage with the bank. Also, Mr. Ambani has a overdraft with the bank, right? So Mr. Ambani has four major credit products with the bank. Now, what will be the expected loss for the bank, what will be the unexpected loss, and what will be the potential loss? So talking about Mr. Ambani's account, potential losses would not be a part of our discussion right now. Initially, we'll first focus on the concept of expected loss and on the concept of unexpected loss, right? And then we will talk about potential loss once again. So basically, say Mr. Ambani has these four credit products. Mr. Ambani gets the following four credit products with the bank. So now from this we'll try to assess the expected loss and the unexpected loss that Mr. Ambani has, or that the bank is exposed to from Mr. Ambani's accounts. So first product that Mr. Ambani has is a credit card. So what is a credit card? The credit card is a card which is given to a borrower and he can actually use to swipe the card such that and he can make purchases on the card and so on. So that is what is credit card. The next is the overdraft, OD. So in an overdraft, I have an account with the bank and I can actually overdraw a certain amount of money if it is required. So for example, if I have say 10,000 rupees in my account and I need money urgently, so what I'll do is I'll draw that money from the overdraft or the OD account. And every overdraft account comes with a limit. Say my overdraft limit is around 30,000. So I have 5,000 rupees in the bank, but I require 25,000. So what I do is I just draw the money from the bank. So I can just overdraw that account and I can draw 20,000 and which I need to pay back in a very short span of time. So that is overdraft. The third product that Mr. Ambani has is a personal loan going with the same bank. And the next product that he has is a mortgage. Now, Mr. Ambani has all these four products, and every month he pays a interest. He pays the EMIs or the amounts or the balances for each of these accounts. So the first part is the credit card. So what Mr. Ambani uses his credit, makes his purchases on his card every month, and he keeps on paying back the money, and he keeps on paying back the money every month. So that is what is credit card. The second part that Mr. Ambani has is the overdraft. So in an overdraft, Mr. Ambani hardly uses the overdraft because he has sufficient amount of money from the amount of salary that he draws every month. He also pays an personal loan EMI and he pays a mortgage. Right? Now, the personal loan that Mr. Ambani has taken is say 2 lakhs. Right? And the overdraft amount that he has is 80,000. And he has a mortgage of 1 crore which he is paying every month. And he also maintains a credit card outstanding. So he has a credit card limit of rupees 1 lakh. 1 lakh every cycle. Right? So this is how, or he has a credit card of limit 1 lakh, and this is how his credit is structured. Right? Now the bank monitors his account every month, right? So the account is monitored as on an account level basis. So credit card monitored by one portfolio manager, OD managed by one portfolio manager, PL managed by one portfolio manager, and mortgage managed by another portfolio managers, right? And all they all put their report or the feedbacks at a customer level, and there is a business head who analyzes these accounts, or an account management head who manages or who looks into the accounts. Now, what is the expected loss? Now, the expected loss is obviously the loss which these persons or these accounts would expect to have, right? So when I talk about expected loss, say the person sees that Mr. Ambani is generally he generally pays back all his dues in time and he maintains a clean credit record. So Mr. Ambani is paying back his dues and he is a very good borrower. So the bank expects that in the next 12 months, right? In the next 12 months, Mr. Ambani has very low chances of going into default. So he is not going to default. his account is sufficiently safely capitalized and everything is in place. Now, the expected loss from this account is therefore very less. Now, talking about the next part. Now, say for each of these accounts is very less. That is expected loss, right? And I know that Mr. Ambani is doing very good and he pays back his credit very diligently over time, and he maintains a very clean credit history. In such a case, I'd say that his expected loss from this account is very less. Low expected loss. Now, observe that this word expected loss is a very tricky word. It does not only talk about loss, but it talks about an expected loss, a loss which you would expect that this account would have, and you are expecting you are framing your conjecture of the loss that you can get, right? The loss that you can get from this account on some basis, right? So there must be certain parameters based on which you are trying to assess these losses. So when I talk about this expected loss, you will see that this contains of two parts or two words, which is expected and the second is loss. Now what do I mean by expected? On what basis will I form my expectation that this account may go into loss? So my first pillar of forming my expectation is my probability to default. So what are the chances that this account will default? So I'll earn a loss on the account if and only if the account goes into default, right? So over here, the first thing that I need to understand is the probability of default. So I need to know that what are the chances that this guy would default in the next 12 months. So generally, whenever a bank is assessing, the bank always assesses the behavior of a borrower in the next 12 months. So in the next 12 months, what are my chances of defaulting? That's one. Now coming to the loss. So first of all, what will happen? If an account goes into a default, so an account defaults, right? The moment the account defaults, the account will have some outstanding balance, right? So that why am I saying the account is defaulting? The account is defaulting because the account cannot pay back the entire money, and hence the account will have some amount or will have some balance outstanding when he defaults. I have taken a loan of a personal loan of 2 lakhs. I have paid back 1.3 lakhs, but then I have been unable to pay back the remaining 70,000 and I go into default. So when I default, there is an unpaid balance, there is an outstanding balance, and that balance is known as the exposure at default. That is known as exposure at default. So the amount of balance which is outstanding at the time of default, that is known as the exposure at default, or the famous EAD that we talk about, right? And what we have over here is the probability of default, or as we call the PD model. So over here, say probability of default or exposure at default. So what we are talking about over here is that, so these are the two very famous components that we always talk about, right? So we always talk about this PD LGD and EAD models. So this is what an EAD is. The amount that is outstanding at the time of default is known as the exposure at default. Now comes the second question, the third part. Now, what will happen when this account has defaulted and there is a balance outstanding? So the next part that the bank will start on with is a recovery process. So the bank will start collections. They'll initiate their collections. And that is where I'll come across the next part. So there will be a recovery which is going on. Now after the recovery, whatever is left of, right? So that left of portion is known as the loss given default. Known as the loss given default. And this is known as the LGD or the loss given. Okay. Now Anirudh has a question over here. So he asks that in EAD, is it only the principal part? No, Anirudh. It is not only the principal part. It is the gross amount which is outstanding, which will incorporate the outstanding principal plus outstanding interest plus other charges if any. So that entire amount which is unpaid to the bank at the time when the bank defaults, that is known as the, so that part is known as the exposure at default. Now from that exposure at default, a certain part of collections are done, and the amount which cannot be collected, that is known as the loss given default, right? So these are the three components of expected loss, right? Okay. So Karan has a question over here that in the next 12 months, a customer may default at any time. So do we get the EAD? We can know EAD only today. Yes, Karan, the borrower can default at any point of time in the next 12 months. So what we do is, so this is why these three models or these three set of models are developed. Now these three set of models are predictive in nature. So say suppose there is a set of accounts today, right? So suppose Mr. Ambani is there on my books today, right? So today is the 26th of May 2016, right? So today is 26th of May 2016, 2018, right? Now I will be generating my, so what I'll do is at the end of the month there would be a monthly profit which I'll calculate. Now I want to know how much of this money should I set aside against my doubtful loans. So which are the loans which are doubtful? The doubtful loans are those loans which have very high probability of defaulting in the next 12 months. So what I will do is, standing today, I want to know that from the 1st of June 2018 to 31st May 2019, which are the borrowers which has very high probability to default, right? So I have a PD model with me which I will run on Mr. Ambani's accounts, right? And for each of the accounts I will see how much, what are the respective probabilities of Mr. Ambani to default. Then what I'll do is I'll compute a a weighted probability of default for Mr. Ambani. Now, when I compute that weighted probability of default, I'll get to see, okay, where is Mr. Ambani actually falling? So, does Mr. Ambani have a very high probability to default in the next 12 months? So, does Mr. Ambani have a low probability to default? Now, if Mr. Ambani has a very low probability to default, then the chances of expecting a loss from Mr. Ambani's account is very low. right? So in that way, I need not bother. For accounts which are very high probability of default, right? I look into their exposure at default. So in the next 12 months, if the borrower defaults, what is the exposure that I am expected to have? So over the next 12 months, what is the outstanding exposure? So what is the estimated exposure that I will have if the borrower defaults in the next 12 months? So that is given by the EAD model, right? And then what we look into is that what is the expected loss, the loss given default that we can earn from that exposure. So how much of the once the recovery process initiates, how much approximately can be collected from this account, the rest will be the loss given default. And all these we are standing today, and using our model we are trying to predict it over the next 12 months, right? So it's not, so basically what we are trying to do is we are trying to come out from an incurred loss framework. So what is an incurred loss? An incurred loss framework is a framework where I can know the loss only after it has occurred, right? But now what I am trying to do is I am trying to come out of this, and I am trying to uh, understand, or what I'm trying to do is I'm trying to assess how much of probability of default is there. What are the chances of that the borrower can default in the next 12 months? What are the chances, what would be the estimated exposure in the next 12 months given that the account defaults? And if the account defaults, how much is the expected loss? What is the loss given the default that I can get? So these are the three broad components, and I'm standing today and I'm trying to predict it over the next 12 months. So it's not that on the day when the default occurs I get an idea about it, but rather it is, so it is identified in over, we try to identify it over the next 12 months. So it's a preemptive action, right? Does that answer your question, Karan? Great. So coming to Kiran's questions, Kiran has a question that if collateral is collected, that does that come under recovery amount? Yes. So for loans which are backed by collateral, the LGD process, or the loss given because recovery process, involves selling of the collateral and the amount that we would receive. But yes, it's a present value accounting which is done, because there is always a time lag between when the bank takes over the possession of the asset and the bank sells of the asset. So in between there is a typical holding time, right? So I might take over the asset today, but by the time I sell it off, it's already 2 years. So getting 2 lakh, say 20 lakh rupees today from the mortgage, and getting 20 lakh rupees or 24 lakh rupees from that asset the 2 years down the line is different, because there is a time inconsistency. So that value has to be discounted to today's value, right? So there is a discounting approach that needs to be done. And in LGD models, the role of this discount factor is very predominantly observed, right? And we need to understand that yes, that the recovery process will happen over a point of time, and I'll recover, say, 30,000 rupees at the over 3 years. So I need to discount those 30,000 rupees to today's value to get the estimated LGD. So we'll come to that concept of discounting over time, right? So when we start talking about LGD, we'll talk about all these parts as well, right? So for the time being, especially Karan, Vishal, and Akash. So is the idea of PD, EAD, and LGD clear? Great. And
Yes.
Kumar, are you now feeling more comfortable with the classes that you had lost out? So are you more comfortable now? Great, great. So now over here, what we have seen is that so the expected loss comprises of these parts, right? So now by through my account monitoring, account management strategy, or through my monitoring of the account of Mr. Ambani, I can make out what is his PD, what is his LGD, what is his EAD, and hence I can compute the expected loss corresponding to Mr. Ambani's account, right? So standing today, I predict that okay, Mr. Ambani has say around 0.03% probability to default in the next 12 months. Now I do this calculation in the month of May, right? So I keep aside my capital and all. But what is the guarantee that that will be the probability when the year ends? Now suppose suddenly something like the financial crisis occurs, or just suppose suddenly some regulations or some events happen due to which Mr. Ambani's business goes a downslide, right? So Mr. Ambani's business falls down. The moment this thing actually happens, right? Say suppose some downslide happens in Mr. Ambani's business, right? Reliance's share prices crash because of some reason or the other. Now, when this happens, there is a huge challenge that we face. That Mr. Ambani's credit capability goes a discrete degradation, and therefore there would be a impact on the probability or on his expected losses, so or on his chances to default, right? And hence the probability to get a loss from this account would obviously increase, but that was something which was not actually expected, right? So this is this event, this sudden credit degradation that happens, this degradation event causes a variation or causes a fluctuation from the expected loss. So therefore, when we are keeping aside capital, right, we not only keep aside capital for expected losses, but we also need to reserve ourselves against unexpected losses. Losses which might occur, losses or events which might create an unexpected degradation in the credit capability of the borrower, right? So that is where this part of unexpected loss comes in. So over here, the unexpected loss comes. Expected loss comes or UL. So I need to keep aside capital for expected loss as well as unexpected losses. Now, apart from this, there can be a third source of loss. Now, expected losses have a greater probability of occurring because they arise from the portfolio behavior, and but that is tracked from the account management strategies. Unexpected losses have relatively lower chances of occurring, but the relative exposure that unexpected losses create for the banks is higher. And the third that we have over here is the potential loss. Potential losses are losses which have very rare probability of occurrence, which which can hardly occur, which rarely occur, say once in 1,000 years. But if they do occur, they can lead the bank to totally crash, right? So these create huge exposure of losses. Say a sudden war breaks out, right? And a few branches of a bank gets bombarded. Then the bank loses out all its customer base, right? Or a city is totally bombarded. The bank faces a huge volume of default because all these accounts, there's a huge, there's a mass set of deceased accounts, and the bank incurs a huge loss on the portfolio, and even to an extent where governments cannot bail that out. Therefore, the bank totally collapses, right? Say the type of potential loss that I'm talking about is an event which led to the collapse of Lehman Brothers, right? So Lehman Brothers was a very huge investment bank. It just collapsed. So with the with the onset of the 2008 financial crisis, so those are events which are potential losses. So I need to keep aside capital for those as well, right? So these are the three sources of losses to which we generally try to keep aside capital for. But the question that comes out over here is that how do we optimally keep aside capital, right? So we need some guidelines, we need some guidances to do that, right? And that guidelines is given by the Basel Accords, right? So that guideline is given, or that guideline is provided by the Basel Accords. And that is why Basel becomes or is such a big buzzword in the industry. And like most of the people who are looking to join the credit risk modeling industry, they are always fascinated with these words like PD, LGD models, EAD models, Basel models, and all these. So, what are these three set of models? So, these three set of models, the PD, LGD, EAD, come in together to help us determine the expected credit losses, right? And around modeling this expected credit loss, a lot of different discussions are going around, right? So one approach that we talk about on the Basel is the EL approach. The expected loss approach that Basel has set forward. The second approach, which has become very famous and is selling like a hot cake, is your IFRS 9, International Financial Reporting Standards. So the impairment standard of the IFRS regulation, IFRS 9, is selling like a hot cake, and we are all computing expected credit losses, right? And it involves PD LGD EAD. So the question that comes around over here is that how is it that we are into the process of doing this, right? And the third thing that we come across over here is so another the counterpart, the US counterpart to IFRS 9 is the CECL models. Now all these are provisioning models. We create provisions for doubtful debts because these are all expected losses, right? And these and the expected losses are, or these EL or the expected credit losses that we use are used to create or used to absorb the losses from doubtful debts, right? So these are used, so these are provisions, so these are allowances kept aside for loans and these losses to be absorbed. So this is what is this is what is expected losses. And most of these three set of models that we are developing, PD, LGD, EAD, for different portfolios across different products, across using different variables, they are all developed to frame this expected loss. So once the expected loss is identified, from there we can, so using Basel formulas, we can compute unexpected loss, and from unexpected loss we can also compute the, using the bar approaches, we can compute the potential losses, right? So we'll go through that entire cycle. But to start off, we will focus on the expected loss concept, right? So we'll talk about these three broad components that expected loss has, right? And the different types of portfolios that onto way for which these can be developed. And we'll also talk about the importance of each of these measures. So what are these three broad measures in? Now, the first measure that we talk about over here is the probability of default. And how is it that a PD model, or what exactly is a Basel PD model, right? So a Basel PD model is nothing but it's a model to compute the probability of default, right? So it's a very simple model to compute a probability of default. And when we are computing the probability of default, we need to follow certain regulations we need to follow certain regulations, certain rules which are laid in the Basel Accord, right? And the PD model that we develop using the Basel Accords is our Basel PD model. Clear? So going forward, we'll take up each of these components, right? So these are the three core models which work in, which are needed to develop, which are required for computing expected losses, from expected losses, the unexpected losses, and from there the potential losses, right? Okay. So before I move on, I'll just take a question which Anirudh has over here. In PD, we are calculating default in the next 12 months, but in the next 12 months, default can be for 1 month or 3 months or entire 12 months. So in that case, how EAD is calculated? Uh, so Anirudh, over here, it is not calculated like 2 months or 3 months. So basically, what we try to understand over here that is the account defaulting in the next 12 months, right? So if the account defaults in the next 12 months, what is the estimated exposure? So I am just trying to understand, is there even one instance, right? What if the account goes into a default in the next 12 months? What would be the exposure? So it does not really matter whether the account defaults in the last 3 months. So within the first 3 months, second 3 months, last 3 months. So is the most conservative estimate of the exposure which is taken, right? So you can think about it like this, that I assume that in the next 12 months, right, the account defaults right in the beginning. So that's the most conservative estimate. So the most conservative EAD estimate will be taken. So I will describe this question. I'll describe this question in more details when I come to EAD model. Right? Okay. Now Karan has a question over here that it's always written that in text, it is written that PD is the risk of business and is covered by pricing, that is interest. So can you elaborate on this statement? Yes, Karan, I'm coming to that. I'm coming to that in a short while. So first of all, PD is not the risk of doing business, right? It's not the risk of business. Probability of default is the chance of a borrower to default, right? So when I'm acquiring my customers on the books of the bank, I I get to see an acquisition probability of default. So based on the historical behavior of the borrower and based on the affordability and the reliability of the borrower, I can always compute an acquisition PD, right? I know that okay, given all the information, this is the chances that the borrower may default on his loans if I give him the loan without looking into his account management or into his account payment behavior, anything, right? Now, the next thing that we talk about is okay. So, so when I give him the loan, I have an idea that okay, this is the borrower. This borrower has so and so chances of defaults, right? Now, when I know that this is the chance that he has to default, I can cover a certain part of that defaults by pricing, right? I cannot cover the entire risk. I cannot absorb the entire risk through pricing. Because if I had to do that, the price of the product or the interest rate would go up very high, right? And in that case, I might end up with an adverse selection problem as well. So what I can do is I can, you know, keep aside, I absorb a certain part of that acquisition PD through risk, through pricing. But certain portions of that has to be captured, or that has to be like pulled through capital, right? So that is the reason why capital is taken. Now, pricing cannot absorb the entire risk, because if that was the thing, the price would be exorbitantly high. And for exorbitantly high prices, it can be the case that the good borrowers move out of the lending cycle, and only bad borrowers come in who take the loan and who may go into default, right? So I cannot make the prices exorbitantly high. So a part of that risk is absorbed through pricing, right? So basically, a more risky borrower is given a higher rate of interest, and his products may be customized accordingly. But the entire risk cannot be absorbed through that. So a certain part of is done through pricing, and the remaining residual risk is absorbed through capital, rather through the equity capital. Clear? Great. So start talking about the probability of default model. Now remember one thing, that whatever models we are talking about over here, right, we are focusing solely on the credit risk, the risk that arises from the credit lending. The next thing that we'll talk about over here is the following. Okay, guys, just give me a moment. I'll start back. Just give me a minute. Okay, so as I was saying, yeah. So we'll start off with a discussion on the Basel PD model, right? So when I talk about a PD model, right? So what exactly is then the objective of the PD model? The PD model is the probability of default model, and the objective of this model that is to understand the chances of a borrower to default in the next 12 months, right? So now, while we talk about the probability of a default model, right? So, be it the probability of default model, be it the loss given default model, or be it the the exposure at default model. One thing that we need to keep in mind is the models that we are developing over here. These models are credit risk models, right? So given that these are all credit risk models, therefore, the focus of these models would be to assess the borrower's risk or the transaction risk, right? Therefore, when thinking about it from a very data perspective, right? So thinking about it from a very data perspective, a data set would contain all kind of variables that are there, right? So it would contain all kind of raw variables, which can include market risk variables, which can include operational variables, and so on. And our objective over here would be to remove all those variables and concentrate only on the variables which reflect the credit risk or the borrower's risk or the transaction risk, right? Now, before we move into this PD model, right? So let's understand what exactly is this Basel PD model. What is Basel? So Basel is a set of accords which are used to, or which lays down the guidelines for adequate, so that which lays down accords or rules which would help the bank becomes capital adequate in nature, right? So it's a set of regulations, and it is mandatory for the banks to be compliant with the Basel records as far as capital adequacy is concerned, right? So that is precisely what Basel is, and this is why Basel has become so important over over the time period, right? Now, the now if you think about this PD LGD EAD models, right? Now we are developing this for different accounts, right? So if you consider the example of Mr. Ambani that I gave, you would see that we are talking about kind of we are talking about kind of different products, right? So we are talking about a credit card product. So the PD model that will be developed, it will be developed for credit card separately. PD model for an overdraft would be developed separately. A PD model for a personal loan would be developed separately. A PD model for a mortgage loan would be developed separately, right? So this is the way these models, the PD model are going to be developed. So you are developing the PD model generally at an account level. So separately for each product, right? So for credit cards as a product, overdraft as a product, every account will have a separate PD model deployed, right? So in this particular case, there are four. In this case, there are uh, kind of four PD models that would be developed. Again, four models that would be developed, right? And then when Mr. Ambani's account, the PD model will be executed. For Mr. Ambani's OD account, the OD PD model will be executed, and like this, and corresponding to each of these products, Mr. Ambani will get a probability of default generated, right? So therefore, since we are developing the the PD models at a portfolio level, it is very important to understand the product portfolio on which the model is developed, or what are the different portfolios that Basel has. How does Basel define a banking portfolio? So what Basel would ideally do is Basel would define the portfolio as, or it breaks the banking portfolio into two broad parts. One is the retail portfolio, the other is the commercial portfolio, right? So it says that every bank has two broad lending books. One is the retail books, the other is the commercial books, right? Now, how is a retail account or how is a retail portfolio recognized? So Basel says that a portfolio will be would be considered as a retail portfolio if it has large number of accounts and and each of the accounts has very small exposures, and these exposures are managed collectively. Now, when we talk about small exposures, what is it that we would essentially ideally mean? What we would ideally mean is that each exposure less than equal to 1 million euro is a retail portfolio, right? The next part that we have over here is the commercial portfolio. In a commercial portfolio, there are relatively small number of obligors, right? And the exposure of each obligor is relatively large. So the exposure of the accounts are large. Now, if you think about a business loan, a typical business loan would start from some crores of rupees, right? A typical retail loan will start from some thousands of rupees or some lakhs, say 1 lakh, 2 lakh, 5 lakh, like this. Now, business loans, they start anywhere around, say, 1 crore, 3 crore, or in millions of dollars. Right. So therefore, the overall number of accounts, it may be relatively low in commercial portfolio, but the exposure of the accounts is very large. Now, on the other hand, what we have is the SMEs. So basically, the commercial portfolio is divided into two parts, right? SMEs and corporates, right? So when I talk about SMEs and corporates, so SMEs are small and medium scale enterprises, and what we have is corporates, right? So for corporates, what happens is, so corporates are organizations whose sales is more than is over $50 million. So organizations or business organizations with sales below or less than $50 million is SME, and above $50 million or with turnover of more than $50 million is corporates, right? Sorry, I mean 50 million euro is SME and more than that is corporates. So the commercial portfolio is subdivided into two parts, SMEs and corporates, and the retail portfolio is divided into three subparts, QRRE, mortgage, and retail. And now, depending on the products that are there, the PD model or the sources of risk for which the PD model arises, or the sources of risk which arises, or sources of default risk that arises would vary, right? So what is a QRRE? The QRRE talks about the qualifying revolving retail exposures. The second is the mortgages. The third is the other retail, right? So within QRRE, QRRE talks about qualifying revolving retail exposures. So QRRE incorporates all revolving products, right? So revolving products like credit cards, overdraft, etc. Right? The next part is the mortgages. So mortgages talk about home loans essentially, right? And other retail comprises of products like personal loans, auto loans, it talks about other products. So when we are talking about, uh, so with the retail portfolio is divided into these three kind of, into these three groups. So QRRE comprises of open-ended revolving products like credit cards. Now it is called a open-ended product, open-ended lending, because you do not have, you know, you do not have this. So what should I say? You do not have a very definite time period to pay it back. There is no definite maturity. So once you pay back the revolver, the credit back to the bank, then your limit gets freed up, and you can again use those credit for sale. So there is credit card, then there is overdraft. So similar is the case for overdrafts as well. Now talking about mortgages, mortgages are home loans. These are secured collateralized loans. And the third is other retail. Now, when I talk about other retail, I have products like personal loans, automobile loans, etc. So these are loans which comprises of closed-end products, right? Which may be secured or unsecured. So these are the three broad groups under which, so these are the three broad groups under which the retail portfolio is divided in Basel. So Basel, so once again in a nutshell, Basel divides the banking books into two parts, the lending books into two parts. One is the retail books, the other is the commercial books. So within the retail, what we have is, uh, the retail portfolio comprises of large number of accounts with small exposures, and the commercial accounts, the commercial portfolio is comprised of small number of obligors, and the relative exposure of each of the accounts is larger. The retail portfolio is subdivided into three sub portfolios: QRRE, mortgage, and other retail. Within QRRE, what you have is qualifying revolving retail exposure. The second is mortgages. The third is other retail, right? So within QRRE, we have products like credit cards, mortgages comprises of home loans, and other retail comprises of personal loans, auto loans, etc. Right? And the next part that we have is, and the next part that we have from here is the following, that uh, the the commercial portfolio comprises of small and medium scale enterprises, right, and the corporates based on their turnovers, right? So let us quickly look into one retail product and one commercial product and try to understand how would the overall sources of riskiness be varying for both these products. So, so if I were to develop a Basel model, how would I do it for each of these products? Okay. So the retail product that we would be talking about over here at this point of time is the personal loans, right? And another retail product that we'll talk about over here is the mortgage loans. So we'll try to assess what are the different kinds of or what are the different sources of riskiness that the account has. So talking about personal loans. Okay, guys, just give me a moment. I'll just close this and then we'll start. I just reopen the scribbler once again. Okay. Okay. So talking about personal loans, right? So what exactly are personal loans? So personal loans are closed-end products, right? So they are basically so they are like nothing but they are term loans. Just a moment. Okay. What we use? So I am just kind of. Okay. So basically, talking about uh, the personal loans. So basically, what are personal loans? The personal loans are nothing but it's a closed-end loan, or it's a closed-end loan product. So it's a closed-end loan product, or it's a term loan, right? So the term loan is nothing but, so basically over here you have a fixed principal which is borrowed, which is borrowed for a fixed period of time, right? So over here what we have is the fixed principal which is borrowed for a fixed period of time. Now once this has been so basically the principal or the payments made over here contain principal and interest. So the so this amount that we actually have over here, or the amount of principal and interest, right? So the payments made over here contain principal and interest, and it has to be paid over a given point of time, right? So this is a product. So this is classified as the other retail portfolio. Now, in this other retail portfolio, personal loans as a product contains, but it's a risky product, right? So this is a risky product because it is not secure. It is an unsecured lending product. Because it is an unsecured lending product, the loan value is amortized over a period of time, and the borrower needs to pay an EMI at the beginning of the month. So at the end of every month, what you need to pay is you need to pay a amount, right? So you actually need to pay an amount at the beginning of every month, and this loan value is amortized over the period of time. Now, having said this, the next part that we need to understand is that what are the sources of risk from which this guy can, from which the loan can suffer, or from which the borrower can suffer. So, what are the key sources of risk? So, one source, okay, so I'll not tell you the source of risk. So, what do you think possibly can be the sources of risk? Yes. So, I am a borrower, right? So, I am a borrower. I have taken a personal loan, right? And I am paying it back over a period of time. So now, what are the sources from which the risk of a personal loan can arise? Okay, job loss. Hmm. Okay, so the sources of risk for a personal loan arises from the following. The first and the most important source, from where the first and the most important source from where the overall riskiness arises for a personal loan is the amount of the loan. So higher the amount of the loan is, even everything else remaining unchanged, right? The riskier the loan is. So the first and the most important one important challenging point over here is amount of the loan. The second that we have over here is the second and the most important characteristic of a loan is the duration of the loan. So more the duration, greater the duration of the loan, higher is the riskiness of the loan. The duration of the loan. So these are the two principal characteristics, right, of the loan. One is the amount of the loan, the other is the duration of the loan, and third is the price of the loan. That is the interest rate the interest rate which is charged on the loan. So that is second and the most important consideration over here is the price of the loan. So these are the three broad characteristics on which the riskiness of a personal loan is based on. Now, since the personal loan is based, it's a closed-end product, right? So there are not very much variations, and not very enterprising challenges are arising with personal loans. But what happens over here is that these are, the from the very way the loan contract has been formed, the riskiness arises from there. Now, why is it so? So let's take up each of these factors one by one. The first that we have over here is the amount of the loan. So greater the amount of the loan is, everything else remaining unchanged, greater is the exposure. So greater the exposure, greater the amount, greater is the risk. So greater the amount of loan, the greater is the risk. Why is it so? Because the greater the amount of loan, greater or higher is the exposure. So greater the amount, greater risk, and the greater exposure, right? So having seen this, so basically, so the greater the amount of loan that I gave, say there is a loan of 1 lakh which is given for 5 years, and there's another loan of 50,000 which is given for 5 years, for yeah, for 5 years. Then the loan which is given for 5 years worth 1 lakh is a more risky loan, right? Because it has been, it is a kind of a greater exposure for the same given years is outstanding, and hence the greater the number of the greater the amount of loan is, the greater is the riskiness, or greater the chances of the borrower to fall short of the amount, and lower the amount of the loan is, lower is the exposure for the bank. Now this loan contains, or it's a, it's kind of a discounted cash flow. So basically, over the period of time, this entire amount of loan is amortized. Right? So over time, the loan is amortized, and it is written off on a month-on-month basis, and there is a kind of a discounted cash flow which the bank gradually receives, right? And this amortization of this loan, or this write-off of the loan over time, happens with the borrower paying an EMI, the EMI of the borrower. So larger. So this is another source of risk which the borrower faces, or that the borrower can face. That is higher percentage of EMI. So higher the percentage of EMI of the income, EMI of the disposable income. higher the higher percentage of EMI or disposable income is, the better is percentage of disposable income. So higher this is, higher the chances of default. Higher the chances of default, right? So higher EMI is, higher the percentage of EMI is a part of the disposable income is, higher are the chances of default, because the borrower will have a lesser fraction of the income to be spent as the EMI, right? So these are some of the factors, right? Now similarly, say greater the amount of duration is. So higher amount of duration would imply that the borrower's financial status has a greater chances of adjustments. So if I talk about the duration of a credit, so if I talk about the duration of the credit, so when I talk about duration of the credit, greater the duration, greater is the chances of default. The duration, greater the chances of default. Greater duration, greater are the chances of the defaulting, right? So why? Because the greater the horizon over which the loan is being paid, more would be your chances of the financial statements to, the financial status to adjust, and hence greater would be the chances of the borrower to default, right? So these are the sources of riskiness which arises from a for a personal loan. Now imagine that if you are to develop a probability of default model or a loss given default model for personal loans, therefore the sources of risk that you need to consider would be very different from the sources of risk of a credit card, right? So similarly, when you talk about mortgages, the very different types of the sources of risk, the sources from which the riskiness can arise, that will be very different for mortgages. Similarly, that will be very again different for corporate portfolios and so on. So having seen this, right, so therefore one thing is very sure, that when we start developing the PD models, when we start talking about the PD model, it's very important to understand which are the key sources of risk, and hence we need to have a very thorough understanding about the product or about the portfolio structure for which the model is being developed, right? So tomorrow, so we'll spark the discussions for the day today, right? Tomorrow onwards, we'll complete the discussion on personal loans. We'll talk about mortgage portfolios, and then we'll take up and we'll have a review of the credit card portfolios, and then we'll talk about the PD model that can be, developed for each of these three products. So we'll get an overall idea of a retail PD model that can be developed, a retail Basel PD model that can be developed for the retail portfolios. So across the different portfolios, what are the key variables? How would you develop the models? What are the key characteristics of those PD estimates? how should the PD estimate be constructed, and so on. So that this is the discussion that we have tomorrow. So tomorrow we'll talk about personal loans. So we'll have personal loans, we'll talk about the mortgage, and we will talk about the PD for the entire retail portfolio, right? So, Karan, to your question, so Karan has a question that can we have access to the fast session? Yes, I'll share over the recording of the fast session and this session with you guys today after the class, right? So, give me time till the afternoon. Let this session get recorded. I'll share over both these sessions with you all. Thank you. Tomorrow we meet at 9 a.m. again. Bye bye.